Hello again, Dave and Tom Moore, the Exchange Brothers. It is June of 2025.
Getting through this year already.
Different market out there, huh, Tom? You were reading something about product on market and what's going on there.
Yep, just got some information from a prominent local broker, and just talking about the number of properties on market. Now the inventory has really increased substantially over the last few months. So, I think that a lot of the people that we deal with were very afraid to jump into an exchange, get their property on the market, because they just felt like there was so little inventory out there to choose from. So I think the fact that people are putting property on the market, it's going to help those that have not, that were sitting on the sidelines waiting. So there's more to choose from. So that should be good for pricing and everything.
So you got to have a place to go. And I guess one of the things that we're working on a lot more right now, it seems like more inquiries, is reverse exchanges. So I want to say this: you cannot own the new and old property at the same time. So don't get yourself in a situation where you are selling a property, maybe it hasn't sold yet, and somebody says, well, go ahead and buy the new one. Then when your old one sells, you can do the reverse. You can't do that. So we've got to structure it. We're either going to do warehouse relinquished or warehouse replacement. And Tom, you're going to talk a little bit about that. But I guess one other comment I'd say is we've had a couple transactions that have come up recently where financing's blowing up on a sale, and that ends up maybe being a reverse, or something else has to happen. If people have the financial ability to do it, they can do the reverse. But the other situation, if they don't have the replacement set up, maybe we're looking at a short-term seller carry that would allow a transaction to get done, and we can still work through the exchange. But why don't we talk a little bit about the reverses, Tom, sort of the main things that people have to consider when they're looking at a reverse, and then the two structures.
Yeah, and I think it's always good to run through sort of a real-world scenario. So we've got a client. I was actually talking to her this morning, and we've been talking for a couple of months now, so it's one of these situations that we like, where we've been in touch early and kind of been able to follow along with what's happening with the transaction for a while. So we discussed, upon initial consultation, all of her options. She had really found a piece of property that she wanted to buy, had an offer on it, but was very confident that she would be able to get her property sold before this purchase took place. So a transaction going across country, Portland into East Coast, can't remember exactly. But anyway, as time went along, of course, got that property acquisition in place, and closing date is approaching. And so just last week, decided, okay, we need to go the reverse route. She still may end up getting the property sold, but we need to get going on paperwork here. So, but had a couple of options with this that we had discussed, and there's the reverse. The IRS does not allow for the client to be entitled to both properties at the same time in a reverse exchange. So she could not just acquire the replacement property and still maintain title to the relinquished property at the same time. So we don't have a normal closing on the buy side. So we're forced into setting up an exchange accommodation title holder, which is a single member LLC that we are the sole member of, that will hold title to either the replacement property, where we term that parking the replacement, or we hold title to the relinquished property, in which case there's a deed transferring ownership from the exchanger over to our EAT prior to the purchase occurring. So the client was initially talking to their lender, finding out, okay, will you loan to the facilitation company's LLC? And they would not. They were more of a big box lender, and so they don't have as much probably product to get into that type of transaction.
So you really need a portfolio lender, somebody who's going to keep it in their bank's assets instead of.
Yeah, you really do. It's going to be a fairly short-term hold, but if you're working with somebody like a the big B of A or Wells or Chase, and they're probably not going to go the route of a loan to an EAT. We've had those certainly in the past. I think it's more often with a commercial type property that they might go that route. But generally, you're going to have to find somebody that's maybe a smaller business bank. Anyway, the acquisition's coming up fairly soon. And she's been, since we did have these conversations early on, she was aware that she may have to come up with the cash ahead of time that's hopefully over the amount that she's going to get out of her sale. She is going to be able to do that. So we don't have to get involved with the financing on the acquisition side. What's going to happen is she's going to come in. She's expecting to get somewhere around $250,000 out of her sale. She's coming in with more than that. Her down payment was initially going to be a little bit less, but she just found through her lender that if she comes up with a little bit more, she's got a point reduction on her loan, so financing will be preferable for her to come up with more cash anyway. But she's going to come in with the down payment. We now generate a note because we're essentially borrowing that money from her to acquire the property. So we generate a note back to the client, in that case, for the amount that she's coming in with for the down payment. When her property does sell, we get the proceeds out of the sale. If the amount that we get is at or below the amount that she put in for the replacement, then the cash all goes back to her as a repayment of that note obligation that we have with them. And she spent all of her cash in the exchange, so she's got a great exchange. And then, what's going to happen if she gets more money out of the sale, then any overage would either have to be used to acquire some other property, or it's going to go back to her as cash boot. Okay.
And not a problem. I mean, 1031's not all or nothing. I think people just really get, they're under the impression they've got to do this or that, or they're going to blow the exchange. And so I just want to stress that you're not going to lose the exchange. It just means you're going to have some tax exposure, and you're going to be challenging your tax people to mitigate that tax consequence with something else. So,
yeah. So, and in this situation like this, where we're taking title to the relinquished property, it's a pretty easy transaction for the client. The only hurdle that we have to deal with is, we have to have that property that she is selling transferred via deed over to our LLC. So somebody's going to have to prepare that deed. So we ask that they get either their accountant or their attorney. Somebody is going to prepare a deed to transfer that property over to us. And if she does get her property that she's selling in escrow prior to the purchase taking place, a lot of times the escrow company, since they're going to be handling that sale transaction anyway, a lot of times they will do an accommodation deed, and they'll just prepare and get that deed recorded for us anyway. So hopefully that'll occur. Yeah.
So you've got two structures. The main thing, like I said, you can't own both new and old at the same time. So don't close a deal, whether it's a sale or a purchase, without reaching out to us. And then you're going to be looking at what you've got to put down versus what you expect that future net sale to yield. And a lot of times you don't know. What if we're in a situation where we're maybe aggregating, let's say 3, 4, 5 properties into one, and you've got a situation where you maybe have the first couple sell, the purchase has to happen, you've got a couple stragglers. What would happen there?
Well, again, you're going to have to look at it. So we will have X amount of cash from those first couple of transactions that we can use for the down payment. Now, again, they're going to have to look at how much more cash is expected out of those remaining sales when they do occur, should they occur. And if they've got a lender, what's the situation on the loan side? Again, if they've got a lender that's willing to loan to us with just what we've got as a down payment, then great, we could close on the acquisition. They're not having to come up with additional cash to represent their equity in those remaining sales. But if they don't have that, if they don't have that situation, then they have to come up with the additional cash themselves to apply on the down payment, and that would allow for us to close on the acquisition, have that property transferred directly over, and then we go on title to the remaining relinquished properties. If the lender is going to loan to us and we can go into the closing with just the amount of cash that we've got, then what happens when those properties do sell, we'll have some paperwork in place with the lender, an agreement typically that states that this is what's going to occur here. We're taking title initially into this LLC, but with these other sales, there's going to be some principal payments on that loan prior to the transfer of this LLC over to either the transfer of the LLC membership interest to the client or a deed to the client. So everybody's on the same page from the beginning. The lender has to agree that, yes, we'll accept, without any penalties, we'll accept these principal payments on the financing, or maybe it's completely paying the loan off. But regardless, everybody's on the same page and knows what's going to happen. We've got a short period of time, 180 days at the most, that this additional money is going to go into this loan, and property is going to be transferred.
So what happens? So once in a while, somebody will say, well, hey, I want to pull some money out of an exchange, or they get the genius idea they're going to do a cash out refi of a property before disposition. Let's say they're going into a regular exchange, so the refi happens while sale's pending. The government's not going to like that probably. But if that's, I mean, I would say that's a step transaction. There, if it was looked at, they would take offense to that money coming out, in our experience through the years. But if they're doing it with respect to, let's say they're pulling money out to have more to put into the replacement for a reverse exchange, could pulling money out of that relinquished property accommodate that? And I guess with that, you'd really, if you were to do it, you'd probably want to look at the equity that was in the property pre the cash out refi and make sure that you satisfied the napkin test with that number, not just the number realized at time of that disposition. Any thoughts on that?
Yeah, I think that's really the important thing, is you look at what is the value equity of what is being sold or given up in the exchange, and what's it going to be in the acquisition. And yeah, if the cash is being pulled out, I'm not saying this is going to occur, but if the property is being pulled out and it's being used as a down payment, and it's all going back into equity on the acquisition side, versus cash coming out and they're using that money to go out and buy a couple of cars and go on a vacation.
They need the cars, though.
It certainly should be looked at differently, and again, we would probably, if the money is needed for the acquisition, I think that's one thing. But if the money is just being pulled out for some other activity or purpose, then they're probably going to want to wait a little while before.
So what's a cash out refi pre-exchange look like? Compare and contrast that to a post-exchange cash out refi. And also, I guess a second part of that is, if they're not going to they just want to pull the money out at close, what should be done to do that safely also?
Well, if they're going forward and doing a refi beforehand, again, what's the reason for the refi initially? Is it to get cash to buy property? If they do it afterwards, if they buy the replacement property and there's a cash out refi afterwards, what's the reason behind that? Are they using that money to put back into the property? Are they using it for improvements in that property? These things will all be looked at, I think. There's not going to be a black and white answer, as we've talked about in so many cases with these exchange transactions, that's going to give them black and white guidance on it.
So don't ask AI.
Yeah.
So really, I mean, if we look at, we've got to be careful if it's in advance. If it was for reverse and we're looking at pre-cash out refi, we can apply the napkin test pre-cash out refi, that it's all been carried forward through that transaction. Typically, a refi after acquisition is not going to be okay, as long as it's a separate action. It could happen shortly thereafter. You can't have it part of it. You can't have a closing and the refi giving you money at close. And then we've got a situation where if somebody wants to pull money out at close, really we had some case law a number of years ago where it needs to, if somebody wants to walk out escrow with some money, it needs to be specifically excluded through the assignment agreement, correct? And we've addressed that through, is it paragraph 8 in the assignment agreement, something like that? There's a blank in there that asks.
There's a spot in the assignment agreement that is labeled as retained taxable proceeds. So it allows somebody, if they're going to be pulling money out of a transaction, it's addressed right in the agreements that they agree that this cash is coming out, and they understand that the cash is coming out is going to be taxable to them. And it's
effectively excluded from the exchange via that assignment agreement. Yeah. That statement.
It goes directly to the client, does not come to us and then go out to them. So we're avoiding that
1031 G6.
Yeah, constructive receipt, where after we receive it, they're not saying, "Hey, send me that money." It's been, as you stated, it's been excluded from the exchange from the get-go.
So if it gets to us, we can't just give you the money. We can only give you funds out of the exchange after you've purchased everything you have the right to buy, and that's something called 1031 G6. And we've got another video on that on YouTube. So if you want more information on that, take a look at that. But that's something you need to be aware of. And I think one of those issues that comes up on that 45th day, really they need to be totally committed to completing the exchange, or they should just say, hey, cancel the deal, because what happens if they ID something and just in case, then on day 60 they want to buy something else, and now we have a problem. So,
yeah, and again, it comes back to, as we say time and time again, the consultation ahead of time, and I go back to this situation with the client that was going to do a normal delayed exchange, but because she ended up having to go over to a reverse. It's not last minute in this case, and she's fully aware and understands the process, and is really very comfortable with it. It's not creating any stress on her end. So, and if she wasn't aware of that, and we got down to the last minute and having to jump in and contact lenders and do all this stuff. When a sale is looming or purchase is looming, and we can't go with this lender now, and then it's a lot of stress.
So really, I mean, people ask all the time when we want them to think about an exchange, and I jokingly say when they buy the property, because depending on how we own it, right? I mean, the three of us, Cece behind the camera and you and I own something together. 5 years from now, we're going to want to go buy the next thing together or not. So it'd probably be better tenancy in common than jointly via a limited liability company. But you got to think about this stuff earlier. And a lot of times I know that when we're consulting people with reverse exchanges, the cost of reverse exchange is significantly more than a delayed exchange. I mean, so you're just looking at that. And I typically encourage people to look at the reverse. It's there. It works great. If you need it, it's there. But use it as a fallback, like Tom's saying. So you can go ahead, open these escrows, work to get everything together. And if we get to that, let's say you've got a hard close date on the acquisition, your relinquished property maybe got kicked out a little ways, well, then the reverse is there to take care of it, or maybe you just offer the seller your replacement property a few $1,000s to wait a little while.
Yeah, and that's a good point, because I was just saying that I know that this property, the client's relinquished property, they've got a showing today, and if that ends up resulting in an offer being made today, and they draft up the agreement, and we're on the 6th of the month. Maybe they're closing on the 6th of July, and instead of paying the additional for that reverse exchange, maybe they'll offer up the seller of that replacement property, offer them a few grand more to hold off for another week or two, and close it as a normal delayed exchange. So, yeah, we're going to put everything in place now for a delay or for a reverse exchange, but that doesn't mean that it might not change within the next couple of weeks.
So when you call, don't just ask the price. We want to know what you've got, what you want to do with it, where you're going with this stuff. I had somebody recently referred in by an oil and gas company we do a lot of work with, and all this person wanted to know, and they actually CC'd one of, a competitor of ours. They CC'd another accommodation company. By the way, we say we're a facilitator, not an accommodator. We take an active role, and that's what we're talking about right now, going into the transaction, understanding what you're doing, and helping you get where you need to go. You're not paying us hourly, so you're going to pay us for doing a job. And I really, 34 years ago, 35 actually is more than 34 years ago, is when we were working with Ron on different investment stuff. He's like, if you're going to have brain surgery, you want the cheapest guy, or you want the one that's going to do it right. And Tom and I used to do a lot of scuba diving. We always laughed about diving regulators. It's only life support. Give me the cheap one. It's like, come on, people. So understand that this stuff is very important. And as Tom was saying with the holding periods earlier, when we're talking about Clarkowski on the dealer status stuff, there's no black and white answer to this stuff. When we're looking at the reverse stuff, it's there. We've been doing it a long time. We're happy to do those transactions for you. But don't look at it as the first course of action. Look at it, hey, it's there, work to do other things if you need it done. By the way, if we're doing a warehouse replacement reverse exchange, it's the same structure as we're using a lot of times for improvement exchanges. So while we're on title to something, you might be giving up a $700,000 property and the replacement property was $5,000 and you got another $250,000 to spend on it. While we're on title to it, it doesn't mean we can't be working on it too. So understand that happens. And if we're building things in different regions, there's regions of this country you don't want to be, if it's wintertime, you don't want to be building. In other regions of the country, you don't want to be building during the summertime probably. So when do you want to do your project? And that's going to dictate what we're doing. But the biggest thing you can do is call us up, talk to us, have the conversations with us. And we like to say, you've worked hard for your money. We're going to work hard to keep it yours.
Yeah, that's all great points. The conversations we have with the clients, it's all very, very relevant information that we need, that they need to think about. And it's certainly time well spent.
So it's been fun today. If you've got questions that you need answers to, we're the guys with the answers. Give us a call, shoot us an email. We're happy to, if you got an idea for a video you'd like to see something covered, give us, let us know. Give us a shout out with that, and we'll be happy to provide some content to your needs. Dave and Tom Moore, the Exchange Bros, and thank you very much for joining us today.
Okay, thank you.